Hello, a very good day to you. Welcome to another episode of Equip Forest Academy. So today we're going to be talking about how to draw with the support resistance, demand and supply, and how to trade with it. Okay. Um, I guess we're all familiar with what support and resistance or demand and supply zone is. For those that aren't, support is simply a level whereby the market comes to and it tends to reverse. Okay, the reason for this is for a market to come to market price to come to a support, meaning the market has been selling. So what happened is the sellers tends to take their profit. For instance, the market was selling from here all the way down here, and upon getting here, they took their profit and the buyers came in and it went back up. Mind you, as we all know, the forex market is simply a battle between the bulls and the bears. Okay? A literal form of a support is simply a floor. When you have it in its but you throw it up, it gets to that floor, it bounces up back. It doesn't penetrate. But the difference between this literal explanation and the forex market is simply the forex market is a flexible floor, it's penetrable, and it can be broken, and also a support can turn a resistance. Okay, as we all know here, as we all see here, at this level, this point was acting as a resistance. But upon the market breaking it, it went all the way here. The market went all the way here before it met with this resistance and started coming back. Now you see this initial resistance is now serving as a support here, which the market obeyed and went back up. Okay, so you see a support can turn to a resistance, and also a resistance turn to a support. Now the difference between a support and demand zone, or a resistance and a supply zone, is the speed at which the market leave that particular zone simply differentiates it. At a support, the market can be ranging on that level for a while before a decision um was taken. But if it's a demand zone, there was the magnitude, the momentum at which price left that place is very, very reasonable and high. And those zones and those points are to be taken extremely serious, because market makers are the one making such moves, because those points has been loaded. Okay, those points are to be taken extremely seriously, because whenever price comes to that zone again, there is a high percentage of chance that same thing is going to repeat itself again. So you don't want to be caught in a situation whereby you just want to see how it goes, and the next thing is it took you unaware. Okay, so that's that. Now let's proceed into drawing our resist support and resistance. And mind you, when you're drawing a support and resistance, before that, support and resistance is in all time frame, from the 1 minute time frame to the monthly time frame. There is support and resistance everywhere. So where do you draw your support and resistance from? You are supposed to draw your support and resistance from the higher time frame, because they are the ones that set the direction of the market. Okay, it's a higher time frame that sets the direction of the market. So you don't want to be drawing your support and resistance on the wrong time frame, whereby you'll be getting a different perspective of the market trend or market direction, and the other major time frame is doing something else. You don't want to be left behind. Okay, so when you're drawing your support and resistance, make sure you start from the daily time frame. Okay, so you come to the daily time frame. I guess by now we must have been acquainted with our MT4 chart and how to navigate it thoroughly. If you've not, you can go to the video I made concerning that and go through it and get started immediately. Here is a reversal point, which is a support. Here it was acting as a resistance here, but now it's not acting as a support here. So that's it. Then another one is come on. Another one is here. The market reversed at this point. So which other point? Okay, these lows. Now the market did a lot. Market did a lot of ranging here. Yes. So that's that. Upon drawing this major point on your D1, you go to your H4 for confirmation, for more confirmation. Now come to your H4 and confirm. You see exactly is in line. Okay, you can see is in line. Okay, as we all know, hope we know, support and resistance is not a point, it's an area. Okay, is not a point. You check out your H4, you can see it's aligned. If it doesn't align, meaning you didn't get it right. Okay, you can see it right. Good. So now what's next? You've successfully drawn your H4, your you successfully draw your support and your resistance on your D1, and you've come to your H4 for confirmation, and is vividly visible to you. Now what do you do if you want to um trade this market currently? Because me looking at it, you can see is almost at the middle of a channel. Yes, the market is between this level and this level. Okay, and the most important place for you to enter this trade, that's how to trade the support and resistance, is from either this level if you are buying, or you are selling at this level. Okay, you don't want to be caught in between. That's why in one of my video I stated that you don't trade excessively, you don't chase the market, you allow the market to come to you. Okay, where you show that your risk to reward ratio is reasonable. Now in this scenario, when this market is at this level, all you need to do is wait. Currently is on an uptrend. We have the weak support, we have a strong support. The weak supports are major areas where there are pullback, retracement, and all that. While major support or resistance are areas where they were major turnovers in the market direction. Okay, that's the most area you should pay attention to, because that's where the real support and resistance or demand and supply zone lies. Because if you pay attention to most of this weak support only, you might get caught. For instance, this point here, you can see there was a bearish candlestick there, and you're like, wow, the market is sinking, is sinking, is sinking. You jump in, and they gave an inside bar, another bearish, and what followed? A bullish. Okay, and if you set your stop loss here and you be like, let's wait, maybe it will come down again, and that was it. It hit this stop loss and kept on going up and up and up even after this loss of consolidation here. Okay, so that's why it's most important to make sure you don't go against your trend. Now, how do you identify your trend? This is your H4 candlestick. Okay, you've pulled up your H4 time frame. Now you look at your charts. Let me just give you guys this little expo. You pull up your EMA, your moving average, your 50 EMA. Okay, your 50 EMA, you pull it up on your chart and look at where the candlestick at. Is it above or below the moving average? That's one question to answer. If it's above the moving average, how far is the market price or how far is the candlestick away from the moving average? That's another question to ask answer. Mind you, the further the market price from the moving average, the stronger the trend. Okay, this is an indicator that does the that's what I say I barely draw lines on my chart. It helps you do the work. Okay, and secondly, you ask yourself, does he has a higher lows and higher high? Okay, because that's one of the major characteristics of a trend. There must be waves. If there's no wave in the trend, then it's no more a trend. It's just a strong run that the huge reversal is imminent. Okay, so that's just it. That's a way to identify and filter a strong trade. And if it's a bearish trend, the market will be below the moving average. And as it's below the moving average, does it has it formed the wave, the lower low and the lower highs? And how far is the candlestick or the market price from the moving average? That's what will help you identify a strong bullish or a bearish trend. Okay, now how do we trade a support and resistance? Now I'm giving you two trading strategy. How to trade it with just your lines that after you've drawn your support and resistance, and also how to trade it with moving average. I've already given you how to identify a trend, a strong trend with your moving average. Okay, I'll still tell you how to trade with it. Now, how to trade a support and resistance just with a line you've drawn on your chart. Now, see, let's assume you've drawn your chart at this level, then the price was still a bit roaming around this area. You've already spotted this line, this zone you've drawn here acts an area of value. What you should expect is a bullish H4 candlestick at this point on this H4 in line with your D1. Your major area of interest should be a bullish candlestick on your D1 on that support zone, a bullish one on that support zone. Then you go to your H4 and also spot a bullish candlestick on that support zone either also rather. Okay, once you've seen these two candlestick forming bullish on the H4, bullish on the D1, is a very sweet sign for you to enter the market. Okay, and once you enter the market, you just simply put your stop loss 40 pips below that zone. Okay, 40 pips below that zone, you are good to go. Or if you assume that there is a probability of a pullback to that initial level or the initial lows, you could make it 50. But mind you, your take profit is the nearest strong resistance. That's when you're taking a buy from a support or a demand level, mind you. So you get these 2 points. D1 entering bullish and the H1. Then if you want to make it a little easier or more of a sniper entry, you go to your H1. Okay, and what did you see on your H1? You can see the market formed a double bottom here. And what does a double bottom signify? A bullish move. And after this double bottom, what happened? The market ran up. Okay, and you can see if you take your entry with the H1, there's a high probability the next candlestick is going to be going bullish and on and on. All you'll be getting is just a weak pullback or retracement, and that's all. So now what you should just have in mind is a bullish on the zone on the D1, wait for the bullish on the H4, that same zone, and go to your H1 and wait for a bullish. If there's still a bullish, perfect entering. If it has not formed yet, you wait for it, and when it's formed, you jump in. Okay, that you can see the whole trend has aligned, the whole time frame rather has aligned, and what's next is, hey, hit the ride, and you ride the trend peacefully and comfortably. Okay, that's for support trading with your support. Now let's talk about the moving average. As you can see here on the, let's go back to the D1. Once you see a bullish candlestick on your D1 at that same level, okay, as you can see here, my purple moving average is in the same place where my line was drawn. That's to tell you the moving average is the same thing when drawing your um support and resistance line. Okay, like I said earlier, it helps me think that the support and resistance, you can see they are on the same level now. But mind you, this is with price history though, because as at that point this moving average won't be here. So it's the price history that will still help me to know that this is an area of value for me to take note of. So once I spot a a bullish candlestick here, I go to my H4. I see a bullish candlestick. I just come straight to my 30 minutes time frame. Okay, I come to my 30 minutes time frame. What do you still see? Double bottom. And what does that signify? Bullish. Now I wait for price to go to cross over my 50 EMA. Remember I told you earlier, once price cross my 50 EMA and do something like a wave, I enter quietly. And once I'm entering this market, I'm entering after the candlestick has closed above the moving average. Then I set my stop loss below this double bottom that was formed. Okay, and mind you, once your stop loss has been set, you've entered the trade, you wait for the market to do his thing, because you are now in line with the higher time frame. Remember, the market doesn't move in one direction. The market move in waves. Okay, so there's um there's room for pullback and all that. And just take a look at it. The double bottom, the A, the B, it crossed, came back below it. Still, it didn't take it won't trigger your stop loss, because your stop loss will be somewhere around here. And what happened? Look at where it take a zoomed off. It's just ride the trend and happily on a steady profit. Okay, so that's how to trade with a moving average. Now we've talked about the bullish. Now let's talk about the bearish. the bearish. Okay, let's go bearish now. Now, this was where the market got to before it started coming down this level. Okay, you've spotted this point earlier on your chart because you've identified the most important thing to do in every instrument you trade is to spot the area of value, so that once market is approaching there, you pay attention to it because it's a trading opportunity for you. You spotted earlier, and this is what the market was doing. Okay, it ranged a little bit before it went down. It was usually between this upper boundary and this lower boundary before it broke down, and it kept on going down. Now you start from the D1. Upon the D1, you've seen you drawn your resistance line, and upon seeing a bearish candlestick, what do? You go to your H4. The same thing. You look for a bearish candlestick. Seen here. Nice. A bearish engulfing. Though it didn't really engulf very well. It engulfed about 90% of the candlestick. For more confirmation, you go to the lower time frame. The H1. What do you see? Because the beauty of this, it helps you filter the noises. It helps tell you that the whole market is about to change from the top down to the bottom. And what happened here? This was the first breakout. It did that twice and it started going down. And the most interesting thing about this is your stop loss is barely hitting unless the market stop hunts it with though it happens, but if you pay attention to the market price, to your price action, it will barely happen to you. Okay, so as you can see as you can see the market still the same zone. It came back down. So all you needed to do was to enter the market upon spotting this network. Upon spotting this bearish candlestick on your H1 is an opportunity for you to jump in. And let's assume we took this trade. Come on. You can see how it was selling from 1.10658. It kept on selling till it started ranging here. Let's assume we left the market at this point. We took almost 300 pips from the market. Okay, so even if your stop loss was 60, 70, or 50 pips, the risk to reward ratio is even more than 4. 1:4. Okay, so you see that's the beauty of trading at an area of value. Now, trading with your moving average. Mind you, you still have to take your direction from your D1. You've taken your direction from your D1, which is the bearish candlestick. You come to your H4, you saw the same thing. Okay, now you come to your 30 minutes and wait for your market price to come below your 50 EMA that you set. Now watch this. The market, I remember, once the market cross your moving average on 30 minutes, wait for a retest. Don't be in hurry to enter. Wait for market to retest the moving average on your 30 minutes and form a bearish candlestick, continuing the trend, then enter, meaning a lower high has been formed. I don't know if you get to my point. The lower high has been formed, meaning the trend is forming gradually. Then you jump in. For instance, you enter this trade. Okay, the market sank a bit, went back up, sank a bit. It was just ranging in this whole place. Okay, now this is where the trend began, and this is what I'm talking about. The market sank below the moving average here, and when it went back up to the moving average, what happened? Did it cross over? No, it came back down, and that's the opportunity you need. That's why I said the moving average is a very beautiful filter that filter the unnecessary noises in the market. So once you enter, your stop loss is somewhere above this whole high, and you can see you ride the trend to this point. Okay, until it did a reasonable, just a minor pullback. Normally, once you see this candlestick on the chart, you should notice an exhaustion candlestick that will be retraced back, and as you can see, it couldn't cross the higher moving average, and it's what the trend continue. So that's a simple way of trading the moving average. I believe you've learned something today, and the most important thing for you to do is to practice what you just heard. Okay, though it's not going to sink in easily, or sorry, it's not going to sink in immediately, but what will make it sink in into you in depthly is when you practice. Okay, go through the video over and over again and replicate what you heard. Let me do a recap. Number one, drawing of your support resistance. Make sure you start drawing your support resistance from your D1, meaning at an area of value. Come to your H4 for confirmation. Okay, and don't rush into the market. Wait for the market to come to you, to come to those area of value. Spotting a trend. Okay, spotting a trend. A trend consists a bullish trend or a bearish trend. An overall trend consists of a higher high or a higher low or a lower low or a lower high, meaning it has wave. It must have wave. The market doesn't just move in one direction. Okay, now for a bullish market, a bullish trend, an easier way to spot a trend is to pull up your 50 EMA, look at the market trend at the candlestick above the moving average. Yes, okay, that's a bullish trend. Is it far from the moving average? Yes, that's now a strong bullish trend. Okay, now how is the wave like, meaning how is the higher highs and the higher lows? Okay, that's how to spot a bullish trend. Same thing with the bearish trend. Is the market below the moving average? Yes. Is it far from it? Yes. That's a strong bearish trend. And how to trade with a bullish, to trade with your moving average? Once the market formed, if it's a bullish trend, the market made a bearish retracement. Once the market formed, meaning on the H4, mind you, on the H4, the market formed a bullish candlestick above the moving average. That's another opportunity for the trend continuation, and you can just jump in immediately. Okay, now here is another example for that, to spot a bullish trend. Okay, continuation of a bullish trend. You can see here at this point the market has been buying from this level. Okay, buying, it got to this point, and from here it dipped back before the market now retraced up. You see, this is a very reasonable bullish engulfing. Upon seeing this is an opportunity for you to jump in the market and do your thing. Okay, and you can see after entering the market here, what happened? Straight up more than 150 pips the market moved. Same thing with the bearish trend, because the market must move in waves. Okay, that's the beauty of the market. So that's all. You've learned how to draw your support and resistance, you've learned how to trade the support and resistance, and you've also learned how to trade with moving average. So all you need to do now is to go and practice what you've learned, and make sure you're profitable with it, because this strategy has a very high percentage win rate of over 85%. Okay, it helps you curtail over trading, because you don't have to trade every time any you want to be in the market. No, because you are not chasing the market, you allow the market to come to you. Okay, once this criteria has been met, feel free. So I hope you've learned a lot today. If this is your first time or for visiting our channel, please do wait to subscribe for more impressive and educative videos. And if there's anything you want us to throw more light on, you can also drop it at the comment section, and we'll do well to do so. So thank you very much, and enjoy the rest of your day.